And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is a very special guest, Dave Mazza, who's head of product at Direxion, and they have about 25 billion in assets under management. Dave, welcome to the show.
Thanks for having me.
So Dave, I always like to begin. Can you give us your background, tell us your story, how you got to where you are today?
Yeah, sure. So my background is probably the opposite of what many people in finance have, and I think in some ways that's a good thing. When I went to Boston College, I really thought I was going to become an attorney. I studied philosophy and political science, but the joke I make is that there wasn't any philosophy companies hiring.
Right.
And after I decided to defer law school, I went to work at State Street Global Advisors in a division that they had there called Charitable Asset Management. And it really is, in many ways, sort of an old school trust business, managing planned gifts assets for foundations and endowments and other folks. But for me, it's a great way to really touch all sorts of parts of finance, everything from the relationship management to the portfolio management, legal compliance, and everything in between. And I really kind of fell in love with the investment side. Worked my way through that organization, then moved up to be an assistant portfolio manager in one of their quantitative portfolio management teams, and at the same time started studying for my MBA. And then from there, moved into the Spider ETF business at State Street and spent many years there prior to then moving to OppenheimerFunds and then here at Direxion. So, I always say, many people, have a belief, when they're in high school or college or even in university that you want to do certain things. I think as we've learned, it's good to take things as they come and be, particularly as a young person, be open to different opportunities.
I love that. So Dave, tell me a little about thematic ETFs, your investment strategy now, how your firm views the marketplace, investing versus trading, etc.
Yeah, so I think, we use investing and we use trading, and everyone, I think, has a different opinion of what does that mean, right? So someone could say, well, I'm a trader, and maybe that means that they're trading infrequently, or I'm a long-term investor, and it turns out actually they're trading too much. But the way I think about it is, think about it from a portfolio perspective, is you have long-term investments, right? And these are really things where you probably shouldn't be touching them very frequently, whether you're managing them on your own or using an advisor. Kind of long-term, whether it's retirement or saving for a house or something, and your risk tolerance is going to be different, of course, at your age or what your objective is. But when we think about trading, that's really the way I think about it, is really short-term. So high turnover, high frequency, monitoring portfolios on a daily basis, if not intraday. And now that's not right for everyone, but if someone has the ability and interest in doing that, that's kind of your trading bucket. And then you probably should have much of it on the investment side, but that's okay. So that's how I really think about the world. And what thematic investing has done over the past few years is almost kind of bridge the gap between those two areas, where historically, whether it was active managers or other folks looking to identify particular securities, what in many ways where they were talking about is, what are these disruptive themes, right? What change is underfoot that we may not be appreciating, whether that's what's happening with industrial companies, or what's all the excitement that's always occurring in biotech, or even the disruption in financial services with fintech and decentralized finance and things of that nature. So thematic investing is really about capturing some of those longer term trends that are occurring and packaging them. And we do so in ETFs, but others do it in different vehicles. And an ETF is an exchange traded fund. And we do that so that someone could say, hey, there's some opportunities here that may play out over the very long run, but I think that this opportunity could occur over 3 months or 6 months or even longer. So that kind of, to me, these type of strategies, and there's many of them that are occurring because there's a lot of exciting things happening in the world today, that it kind of bridges that gap between true long-term investments and true kind of more tactical trading.
I love that. So do you find most of your investor base or shareholder base are actively trading your ETFs, or do you find them to be more of the long-term buy and hold investors?
So we're a unique firm, right? Where the majority of our actual ETFs are what's called leveraged ETFs. So what we're doing is we amplify exposure to particular areas of the market. So it could be large cap stocks, small cap stocks, China, treasury bonds, what have you. And they're really intended to be used for trading tools. They're not long-term investment vehicles. And so what we see is that whether you're a retail investor who's trading on your own account, or even an institutional investor who wants a tool to say, hey, I believe that semiconductor stocks are going to do well, or my model tells me going to do well over the next day or two, they use our products to help them with that. We also have products that are called inverse ETFs, right, that they provide the opposite exposure to a particular area of the market. And right now, as we've been in a period of market volatility that we haven't really seen, that many people haven't seen for some time, we're seeing interest in those products increase because maybe someone has a portfolio of, I'll use for example, financial stocks. They like their ownership of Citigroup or JP Morgan or Goldman Sachs, what have you, but they believe that they don't want to sell them. They have long-term capital gains. You could use an inverse ETF to hedge some of that exposure in this period or when they announce earnings to help with that. So there's different utility for these particular products, but they really are supposed to be tactical trading tools, at least on the leverage and inverse side. And then our thematic ETFs, which don't have that embedded leverage, those are used more longer term. And I'd say they're a 6 months, 12 months, or even longer time period.
I love that. So Dave, tell me a little, how do you handle risk and what mistakes do you see people make with respect to risk management?
So what we think about risk in two ways. We think about the risk that we have actually managing the products, working with our counterparties, the folks that we trade with. And we use a multitude of tools for that, whether that they're third-party tools or ones that we've created on a proprietary basis to understand, what does our daily risk look like as a business. But I also like to think about, of course, risk of folks using our products or just in general in the marketplace. And many people, risk is defined in a quantitative fashion, standard deviation or volatility. That's not really how people think about it. People think about risk as losing money, whether it's right. So it's really that drawdown that people are concerned about. Can you absorb a 25% drawdown in a period or a 50% or maybe more? So, a great example is what's happening with Bitcoin, right? Since its history, Bitcoin has been in long periods of 50% or greater drawdown. And I'm not saying, I'm not advocating someone should buy it or not because of that, but that's the reality. It's a volatile asset class. Then there are periods where it has unbelievable outperformance. So it has to go back to what type of loss as a trader or investor am I comfortable? And then do I need to either work with my advisor if I'm a do-it-yourself investor to really solidify that? And until you solidify that, in some ways, at least for me, it took experience making some wrong decisions to feel it.
Right.
Then you can know, okay, this is really the kind of risk bucket I should think of myself. And the other thing that this is a personal thing I do that it's not novel to me, if you will, is I have sort of different buckets of assets. So meaning I can I can balance some more speculative type investments, some more riskier stocks alongside, more stable, more index-based investments, because I know that that's going to do what it's going to do. I'm not going to touch it. I'm probably only going to ever add to that from a dollar cost averaging standpoint. And then I can have the ability to take on some more risk. And if those things don't pay off, that's okay because they're smaller portions of my aggregate portfolio.
No, I love that. So, Dave, tell me a little bit about timeless lessons. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Yeah. So, we just talked about risk, and that to me was a, really important lesson. One of the areas that I learned when I was, as an analyst and as an assistant portfolio manager at State Street in a previous life is to really also think about your time period for a particular investment. They go hand in hand, right? So many studies have shown in US stock markets and UK stock markets, stocks win all the time, right? Over 50, 100-year periods.
Right. Yeah.
Over 1 year periods, over 1 month periods, not the case at all.
Right.
So if I have if I'm truly saving for retirement and I'm 25 or 30 years old, you should probably be comfortable, probably is a key word here, taking on greater risk, because that money is going to sit and grow. If you need it for shorter periods, or if you can't just absorb that loss, think about that. And your allocations are going to be vastly different, whether that's thinking about allocations toward risky assets like stocks versus bonds or even cash, or anything in between. What's interesting now is there's been a generation of investors, and I am in this generation, who have never faced true inflation at all. We've only faced deflationary pressures, and every model that I developed quantitatively, every textbook has basically said that central banks and the Federal Reserve have the tools to fight inflation, and we're about to see if all of that is true. Because the most dangerous words in finance are "this time is different." But I think the timeless lesson people need to understand is that times can be different, particularly when it's kind of generational movements, if you will.
No, I love that. So I have a few thoughts there. One, is think of a 747. It needs a long enough runway to take off, right? So if you don't give it that time, it's not going to be able to take off. And then I just published a new book. It's #1 on Amazon, called Psychological Analysis. In it, it's a third school of thought in addition to fundamental and technical analysis. In it, I talk about what you're talking about, which is time arbitrage. Most people, they miss the forest because they're too busy looking at the trees, the leaves on the trees, like the intraday charts, and even the daily charts in most days don't even matter for the most part. I love what you're saying. So let me ask you about fundamental and technical analysis, charts and looking at fundamentals. Where do you lean in those two departments? Are you more heavy on the fundamentals? Are you more heavy on technicals? How do you use both of those tools?
So it's interesting. So if you were to ask me this about 10 years ago, I would have told you efficient market hypothesis, technical analysis is worthless. Don't even read the books, forget about it. Yeah. Well, guess what? Like, I think any investor, you need to appreciate charts do matter. But I learned truly in kind of a quantitative setting. My mentors were probably overly focused just on the data. Right. And if the data told us EPS revisions were improving, EPS growth was improving, valuations were low, the stock had high ROE, that's a perfect buy. Well, guess what? You also need to be relevant is what is the marketplace really telling you about that? Right. And that's, to me, that's how I use technical analysis. And that's how I think about charting, is that, I'm not a chartist, there's many great ones out there, but to me, I want to have a mosaic of information when I'm thinking about an investment. And I really use that also when I'm thinking about creating new products that can be packaged. Some of them might just be fundamentally based, but we also need to appreciate that maybe has some flaws in it, and that could be okay. But just saying I could only do one thing or another, to me, I think is a bit of an antiquated way of thinking about investing or even trading.
Yeah, I couldn't agree with you more. I love that. So we talked about timeless lessons, fundamental analysis, risk management. Talk about some timeless mistakes you see people make in the market, and how do you avoid those?
Yeah, look, I mean, I think one of the mistakes that we're seeing people now is an over-reliance on social media. And there were probably, back in the tech bubble, there was probably an over-reliance on what your neighbors were buying, right? Or just what was on nightly news, when they started publishing the NASDAQ along with the Dow and the S&P 500 on your 6 p.m. news. The same thing happened in the housing bubble and housing crisis, right? Everyone wants to keep up with the Joneses. Right now, we have more power in our hands with our phone than we've ever had before, than it took to land men on the moon, decades ago. But that actually, I think, in one hand, is a crutch, and also can be detrimental to us because there's such an information overload. So what I see, particularly when I talk, whether it's younger family members, cousins I have, they're very reliant on sort of what today's news is or what we're hearing, and particularly when you're experiencing a drawdown, it's hard to sort of weed some of that out. So what I'd say is, shut down your Reddit, your Twitter. If you're trying, use that information now, but pair it with your own work and opinion. Because the worst thing I think that could happen now is that people who maybe bought into the market at maybe too high of a valuation ratio or at all-time highs, start selling everything. And we're not there yet. We're not seeing capitulation, but we may start selling everything and then don't get back in, or don't have a thought of, okay, well, if I'm going to sell Disney, am I going to buy another stock, or am I going to buy an index, what have you? So everyone has to make their own decisions and be comfortable with, that's what makes a market, whatever everyone's particular opinion on a security is, but sort of have a plan and a thought process. If you can be subject to that information overload, which I know I can be too.
Well, we're all human, right? We all have those biases and mental walls and all that kind of fun stuff too.
Correct.
So, okay, I love that. So let's talk about the best piece of advice you give your 20 or 30-year-old self. What would that be and why?
I would say the best piece of advice that I would give myself is to I was lucky where someone told me to save, but I'd say save more, right? Is the date, if it just look, again, and I'm fortunate, particularly compared to others who even have the ability to save. But if you do, and it doesn't matter how many zeros you have, try to do it, because then when you look at your 401k going from when you're 20 years old to 30 to 40 to 50, it's gonna be there. So if you're not maximizing that, find a way to do so. Pay off your debts or what have you. And again, it's easier said than done, right? Because when you're young, all I wanted to do was go. I finally had some money. I didn't grow up with a lot. Finally had some. Hard not to say I want to go out on Friday and Saturday, dinner, drinks, whatever. Hard to do. Yeah. But try to stash some away. And again, it's less of, if you want to buy yourself a latte, go. Some people have different opinions on that. I'd probably say fine, but don't be overly reliant on just those experiences. And not that $5 doesn't matter, because at this point now there's probably way more than $5. But my point is, find a way to have that balance. I know that I was not necessarily as good as that as I should have been, and so to me, that's the advice I'd give myself.
I love that. And then let's talk about how you go about the process of creating new products, and talk me through that a little bit. Do you look at ideas? Do you weed them out? Like, do you rank them based on strongest to weakest? How does that whole process, that creative process work?
So that's kind of my favorite part about my job. And I'm lucky because I can kind of take my suit jacket off and put on my proverbial lab coat. But the best ideas that we've always had, that I've had, are, come from others. They come from what's happening in the world. So, for me, that's why I say social media can be a good tool, because I can start hearing some chatter. People are interested in mRNA as a technology or what have you. And look, the data is backing it up, with the COVID vaccines, that this works, right? So then you can kind of take that, then go do some actual research to say, can I build a product here around these particular securities? If we can build it, is it sufficient liquidity to trade it? Can we actually manage it? If the fund grows, are we gonna have challenges or not with that particular case? So it's kind of balancing, hey, is there something interesting happening in the world? Do we believe that change is afoot? This is primarily on the thematic side. Mm-hmm. And that we believe investors can take advantage of. But if it's just kind of this longer term, something that is not able, like quantum computing is a good example, really exciting. Yeah. And there are companies that are involved with it, whether it's on the semiconductor side. But the biggest companies involved with that are also mega cap companies, Alphabet, IBM. So am I really getting anything different if I were to create that particular product? Mm-hmm. Hard to say. Mm-hmm. And that's really where the balance of creating new products comes into bear. It's saying, hey, is there an investment case out there? But is reality with the actual securities that you could own going to make that interesting and actually have the ability to outperform that someone couldn't do on their own, or it doesn't already exist in the marketplace in a different form?
That's a really, really good point. So what about the ideas where you say no to them? Is there a committee there that helps you, or is it just you, or how does that process work? And how do you go about saying, you know what, this might work, but like you said, we're too early. Quantum computing makes a lot of sense on paper, but practically, what are we going to do? Buy 2 stocks that are already in the queues or something like that? It doesn't make any sense. There's no value. So how do you go through that dance?
Yeah, so we're a relatively smaller firm. I've worked at places with mega committees, and it's got to get through committee 1, committee 2, committee 3, and by that time, the idea may be too old or it has to get diluted. We're relatively nimble. So I have a small team who's kind of doing the legwork. And if there's something that's interesting when we, frequently are doing this work, we'll then, kind of immediately bring in our portfolio management and risk folks. And then we'll pair that with the more commercial side, our sales, marketing, distribution, and then come together and rank order those ideas. Right now, for example, when we're that quantum computing is a good one, right? Can we actually do it, right? Even though it's exciting. In our opinion, not necessarily. It doesn't make as much sense. In the example of mRNA, when we launched that particular ETF, that's where we said, wow, like we're going to have to go really small in market cap to find companies that are involved with it. But I don't want to own Pfizer. And many people would say, hey, why not? Well, Pfizer is licensing that vaccine technology from BioNTech. Right. So that's the name we own. So how do I find the next Moderna, next BioNTech in that particular example? So that's where we made the decision as a group saying, we're comfortable owning some microcap stocks here, some stocks that trade below $5 a share, because those are the names that have the long-term, potential to be disruptive and bring an mRNA to fight Lyme disease or HIV/AIDS, what have you. And commercially, that makes the most sense, so that we're not just repackaging other pharmaceutical companies or medical companies in this and then calling it something new, because that's not really, in our opinion, what people want.
Yeah, I love that. So final question for you, Dave. What's the best piece of advice you'd like to share that we haven't covered so far?
I think that the best piece of advice is do your homework, right? As boring as that sounds, and maybe as much as I personally didn't want to do my homework, when I was actually in school or even when I was in my 20s thinking about saving, you got to do it, and you got to know what you own, right? So I don't necessarily care what my friends are saying or what even smarter people than I are saying, unless I do my own work. So I give that advice to anyone. And whether we're talking about buying a treasury bond, know what it is, know how it actually works, know how the rate setting mechanism works. You don't have to be an expert, but take your time, because usually whether you're thinking about an individual stock, a fund, or even something much, much simpler, if you don't do that, that's to me when kind of some of the issues can go awry.
I love it. Well, Dave, thank you so much for coming on the show. Hopefully we'll see you again soon.
Thank you.